So, welcome to the last agenda item of the day. So my name is Erik Eliasson and I'm the chair of the Sustainable Finance Lab. And I have the honor to present the first ever Sustainable Finance Lab Award. And this is an initiative that we launched earlier this year, where we are awarding the best master thesis industry pitches. We have received 16 very good submissions. Mark and I have spent a lot of time going through the different submissions, and it's been very, very difficult to select 3 winners. But we have managed to select 3 winners, and we have 2 of the winners here with us today, who will also then present their pitch, where we focus on why is this a relevant topic, talk about what has been challenging in relation to doing this, as well as also outlining also why this is a relevant topic. And the reason why we launched this award was, of course, to foster and also reward students also which looks into pressing challenges concerning sustainable finance. Because it's, of course, very, very important that we spend more resources and efforts and so on to, of course, address these challenges. So unfortunately, those that came in third, so Axel Nilsson, Johan Magnusson from KTH, who wrote a math thesis about ESG size ownership, understanding heterogeneous market reactions of China's carbon neutrality commitments. They are not here today to be able to present because they are on their exchange here in China. But I'm very pleased to have Olivia Dahlman with us today. And Olivia will talk, has done thesis then on when water rises, do prices fall? Differences in different study on the 2021 Gävleborg flood. And you will get around 10 minutes to share some information around your thesis. So let's give a round of applause to Olivia.
Thank you, Erik. I'm just going to quick introduce myself. I am in the final year at the Master Program in Environmental Economics and Management at SLU in Uppsala. So I'm going to ask you a question. By a quick show of hands, how many of you own your home or have a mortgage? Okay, nice. Great. Now, how many of you have recently thought about how climate change might impact the value of your home? Great. That's a lot of hands. Great to see. Still, I think we rarely stop to really consider how climate change might impact something as personal as the value of our homes. And that's exactly what my thesis explores. So, as Erik mentioned, my thesis is called When Water Rises, Do Prices Fall? A Difference in Differences study on the 2021 Gävleborg flood. So basically, I'm looking into how residential property prices in Gävleborg changed after the big flood that happened in August. And to do this, I collected detailed property transaction data from Booli using their API, covering about 14,000 property sales in Gävleborg County. Additionally, I was fortunate to access flood exposure data from ValueGuard, including over 47,000 properties in Gävleborg County. And ValueGuard, they created a flood impact score ranging from 0 to 100 based on flood depth using blue spot analysis, multiplied by rainfall intensity. And matching these 2 data sets was quite challenging. I used addresses and postal codes for matching and turned to Google API to obtain coordinates when direct matches weren't clear. And once the data was ready, which took longer than I expected, I started my analysis using what's called a difference in differences approach. So I first split apartments from houses because apartments made about 80% of the data set. And each apartment had a clear flood exposure score. So scores of 20 or higher were treated, scores of 0 were controls, and I dropped intermediate scores. I then calculated how many weeks before or after the flood each apartment was sold, and I limited my main analysis to a 2-year window, 1 year before and after the flood. Transactions outside this time frame was grouped as earlier or later. So because prices naturally depend on factors like apartment size, number of rooms, floor, and monthly fees, I accounted for these differences in my model. And the approach itself involves 2 comparisons. So over time, price trends before versus after the flood. And also the second one, between groups. So differences in price changes between the flooded, treated apartments and the unaffected control apartments. And this was done using a regression with an interaction term to isolate the flood's impact clearly, along with weekly fixed effects to control for typical seasonal fluctuations and clustering by postal code to capture local price variations. And finally, I conducted what's known as an event study, examining price impacts week by week. And by plotting these results, I could visually confirm whether property prices were on parallel trends before the flood, and they were. So what did I find so far? Before the flood, high flood score apartments sold for about 2,600 crowns per square meter, more than otherwise similar unaffected apartments. And that's not a lot in Stockholm terms, but it is in Gävleborg terms. And after the flood, that extra premium shrunk by nearly 1,500 crowns per square meter. And it was statistically significant, so it's unlikely to be random. So put it on another way, the 1,500 crowns drop represents about 7% of the treated group's pre-flood average price and 9% of the control group's pre-flood average price. So what does this actually mean and why should we care? So as you all know, climate change is making extreme weather more frequent and more severe across the world. And the Gävleborg flood in August 2021 is a prime example. Over 8,000 insurance claims and 1.6 billion crowns in payouts in a region not previously seen as a high risk. And in Sweden, housing makes up about 41% of household assets, and 78% of household debt is tied to mortgages. That means even small changes in house prices can have a big effect on household finances, on banks, on insurance, and even on the wider economy. But right now, valuations, lending, and insurance model often don't properly account for these risks. And if home lose value or become insurable, we are looking at real risk of stranded assets, financial losses, and growing instability. So my thesis provides concrete evidence based on actual sales of how the market responds to flooding. It shows that even in Sweden, climate risk is already affecting real estate prices. And as events like these become more common, having this kind of data is crucial for better risk assessment, smarter investment in water infrastructure and climate adaptation, and more resilient financial systems. So in short, if we want to build a resilient financial system in a warming world, we need to understand not just where the water goes, but what it does to value when it gets there. Thank you.
So, thank you very much, and congratulations.
Thank you.
And now we have the first prize, and that is to Ebba Langemar and Astrid Albertsson at the Stockholm School of Economics, who have written a thesis around Save Now or Pay Later, a comparative study between BNPL and SNBL in the Swedish e-commerce context. So welcome to the stage.
Okay, thank you so much for the kind presentation, and we are super honored being here today and having such many people with very interesting presentations before us. So our thesis was titled Debt or Discipline, and is an experimental study comparing two different payment methods, namely Save Now, Buy Later, and Buy Now, Pay Later, which I think most of you are quite familiar with already. But before going into what we found, I think we could use some background information. So payment methods are no longer just transactional tools. They shape consumer behavior in ways such as spending, purchase satisfaction, and likelihood of return. One of the most common reasons that consumers abandon their e-carts is due to the lack or absence of their preferred payment methods, which truly sheds light on the importance of retailers to actually have a wide range of options for consumers to pay with. In recent years, new innovative payment solutions have been introduced to the Swedish market, and Buy Now, Pay Later, or simply BNPL, is one of them that has gained a wide adoption in e-commerce. It allows consumers to receive their products immediately while deferring payments, which offers convenience and flexibility. However, as many of us know, this has also received increasing criticism in media lately due to its associations with overconsumption due to impulsive purchases, as well as the potential for debt accumulation, especially among younger consumers. Moreover, we have also seen that this payment method is associated with higher return rates, with numbers pointing towards 50 to 55% higher than other payment methods. And this truly sheds light to how sustainable and how profitable this payment solution is for retailers to offer. As a counter-reaction, we've seen rise of new economical models or financial payment solutions. One of them is Save Now, Buy Later. This concept flips the structure around and requires the consumer to save towards their desired purchase upfront. Usually, this takes place in setting up a dedicated account to which the consumer makes regular deposits, and once the target amount is reached, they can complete their order. And to incentivize this kind of savings behavior, SMBL providers usually use some kind of benefits, such as discounts or other kind of cashback rewards commonly seen. While this is in its very early stages across the globe, we have seen pioneering efforts, mainly in the Middle East and Northern Africa region, as well as parts of the US and parts of Europe. And now this solution has also entered Sweden, posing a good opportunity to us to explore how this payment solution compares to the BNPL model, which is widely adopted. And in our study, we have looked into consumer behavior in terms of impulse buying behavior, post-purchase regret, as well as return intentions. And our research questions were, how do SMBL and BNPL differentially influence impulsive buying behavior through underlying psychological mechanisms? And secondly, how do these two payment methods influence the relationship between impulse buying behavior and post-purchase outcomes? Now over to you, Ebba.
Yes, thank you. So to examine these formulated research questions, we employed a quantitative research methodology where an experiment alongside an online survey was used. And the experiment took place in a fictional e-commerce setting with different conditions where the participants were randomly assigned to. So we had one condition for the SNBL group and one for the BNPL group. And to get a representative picture of the Swedish population, we used Swedish consumer panel to recruit our participants. And in the end, the final sample consisted of 874 participants. And in this experiment, participants were informed about their assigned payment solution early on and then reminded of this. And we also asked them to immerse themselves in this fictional shopping experience. And once participants had completed the experimental phase of the study, they continued by answering the survey questions connected to different constructs that we had picked. Okay, so now you might wonder what we discovered when doing this, because we actually submitted our thesis, so it's done. Well, to begin with, one of our main findings revealed that SNBL surprisingly led to higher impulsive buying than BNPL. We believe that this unexpected outcome may be attributed to several reasons, and I don't think we have time to cover them all today here, but we elaborate more on this in our paper. And naturally, we also think this finding needs some more investigation. However, another more expected finding that was revealed from our study is the positive relationship between impulsive buying behavior and return intention, which was mediated by post-purchase regret. So in other words, this implies that we found that a statistically significant support for that impulsive buying increases consumers' return intention. And this relationship can be explained then by consumers' post-purchase regret. And we also found that this chain reaction, as well as the direct relationship between impulsive buying and post-purchase regret, was more pronounced among BNPL users. So this suggests that the emerging SNBL model is associated with less post-purchase regret and subsequent return intention. So then moving on to how this study contributes. Our study has several implications for both researchers, regulators, and practitioners. First and foremost, our study is among the first to empirically examine SNBL, both as a standalone payment solution and to compare its behavioral effects with those of BNPL. Simply put, our study offers unique insights and theoretical contributions to a yet fairly unexplored area of research. Secondly, our study is important as it sheds light on this emerging payment solution. Given the rapid adoption of and subsequent concerns faced by BNPL services, regulators should proactively examine emerging payment solutions like SNBL before widespread adoption. This is important, and we think it should be done to avoid potentially repeating past oversights in consumer protection. And lastly, our study has multiple implications for retailers. For instance, as our study suggests that consumers' return intention is less likely with SNBL compared to BNPL, this means that it could help retailers reduce costly product returns, improve profit margins, and support more sustainable practices. We also anticipate that retailers could use SNBL as a tool to improve customer engagement and customer loyalty. This as SNBL enables multiple digital touchpoints, which can be used to deliver personalized offers and communications throughout the whole customer journey. And finally, by adopting SNBL, retailers would signal a commitment to consumers' financial well-being and responsible spending. We argue that this could enhance brand trust and long-term loyalty among consumers. Thank you so much. That was it for today.
Thank you. Tack så mycket.